And good morning once again, options traders. Well, I was just posting with another trader in this group about potentially using some back spreads for a particular outlook that he had based on volatility. And I was mentioning you could use this back spread because of the Trumpification effect, and you could put it to your advantage. And of course, people started emailing and saying, what in the world is Trumpification? So it's an important term that all options traders should understand and know it has nothing to do with the president. But let's take a look at what this effect is and how it affects your positions. To understand it, we have to back up a little bit first to the concept of delta. And I think most of you know that delta is one of our key Greeks, showing an option's responsiveness to different variables. And what does delta show? Well, delta shows the option's responsiveness to changes in the stock's price. And delta is roughly equal to the probability for the option to expire in the money. I say roughly, and I like to highlight that because there are a lot of people out there who will tell you it is the probability, and that is simply not true. It is under what's called a risk-neutral valuation. That's an entirely different video, but it's not exactly the probability. But if you at least think of it as the probability, it will help you to understand why this effect comes about. So for instance, let's say that we're looking at an option that has a delta of 60, and you can find this on your broker's platform. And we also are looking at the stock that's trading for 100, and we see that the $100 call is trading for $5. What is this delta 60 telling us? What it means is that if the stock rises right now to 101, rises by a full dollar, that this $100 call is going to pick up about 60% of that, or 60 cents. It's going to trade for about $5.60. So notice that I made the stock's price increase by $1, but the option's price didn't pick up one full dollar. It picked up 60% of that, or 60 cents. And the reason that the option picked up 60% of that amount is because that was the option's delta at that moment. Keep in mind that for the next dollar move, the stock going from 101 to 102, that delta is going to change again. So don't think that just because you see an option's delta was 60, that it always stays 60. It's always just for a snapshot in time. But if you at least understand what the delta is telling you, and that it's roughly the probability for the option to be in the money, it's going to be a lot easier to understand why the Trumpification effect occurs. So what exactly is this effect? Well, it has to do with the effect of time and volatility on an option's price. And what it says is that out-of-the-money options become more likely to expire in the money as we increase time and or volatility. In-the-money options behave just the opposite. They're going to become more likely to expire out of the money if you increase time and or volatility. And this effect is what's called Trumpification. So another way to say this is that all option deltas move toward 50 as you increase time and or volatility. Now it's also important to understand that we say toward 50. They don't move to exactly 50, but they move in that direction. So graphically, it's going to look like this. On the vertical scale here, we've got our deltas, and on this red line here going horizontally, we have time. So notice that if we have an at-the-money option, the delta will be roughly 50. So up above the red line, I'm looking at in-the-money strikes. And so their deltas will start to get higher and higher and potentially get all the way up to 1.0. Out-of-the-money options are going to be below 50. However, as we increase time, we start moving to the right. That's what this red line is here. Remember, that's time. Notice what's happening to the deltas. The deltas are getting compressed for the in-the-monies, so they might be moving from, let's say, 70 or 60 down toward 50. The out-of-the-monies might be moving from, let's say, a 30 delta up to 40 and 50 and so on. But notice that these blue lines don't exactly ever touch the red, but they start moving in that direction. But it's this compression effect. As I increase the time, I could also do the same thing by increasing volatility. Moving time and volatility are just two different ways of kind of saying the same thing. By giving the option more time or more volatility, I'm giving it more time to move in the money, if it's an out of the money option, And if it's an in the money option, I'm giving it more of a likelihood for it to become out of the money. And so that's why these probabilities start getting pushed towards 50. So let's jump over to the SiBo's pricing model and take a look at this effect in action. So here's the SiBo's pricing model, and we've seen this before in many videos. I'm going to start off with the stock and strike at 100, so it's an at the money option. And notice over here it's telling us that our delta is about 50, a shade above, but that's going to be true even if I increase the time and or volatility. These deltas are going to stay roughly at 50. So watch what happens though if let's start off by making the stock price 105. So we're just going to look at the call options, but the effect applies to the puts as well. So this option is now $5 in the money, trading for $5.64, but look at the delta, all the way up to 81. Why is the delta so high? Because it's an in the money option. It's 5 points in the money. And also coupled with the fact that there's not really a lot of time till expiration, not really a big volatility, we're fairly confident that this option will stay in the money. And so you could think of it as though we're saying there's an 81% chance, or that we're 81% confident for it to stay in the money. And because of that, if the stock moves $1 right now, this option is going to pick up 81% of that, or 81 cents. But watch what happens as I increase the time to expiration. I should have less confidence about this option staying in the money. So let's move this to 60 days, and this delta should decrease. So watch this. And now it's gone to 74. Let's make this 120 days, and the delta drops again. Let's make it 360 days. Delta continues to drop. Now we will reach a limit, and again, that's another video, but you can see that we're at least moving toward 50. But now let's move this back to 30 days and watch how I can do the same thing by increasing volatility. Let's move this interest rate back to 0. So this was our starting point, delta of 81. If I increase the volatility to 30%, delta drops. Increase it to 40%, delta drops. So sometimes I tell traders, think of this like your football team being in the lead. If your football team's in the lead, where do you have more confidence about them winning? If they're ahead by 7 points at the half, or if they're ahead by 7 points with 30 seconds to go on the clock? Well, obviously, with less time on the clock, the more confidence you have if they're in the lead. That's exactly what's happening here. This is an in-the-money option. So if I can take all the time off the clock, let's say down to a day to expiration, or make the volatility really low, make it, let's say, 5%, look what happens. Deltas now go to 1. We're saying, yeah, we're confident that this option is going to become stock in the future, or that it's going to be in the money. Now let's go to the other side. We'll go back here to 30 days, 20 volatility, 0. Let's make the stock price 100. Let's make the strike 105. And so now it's an out of the money option. So take a look at the deltas. See, they're pushed way down to 20. Nobody has any confidence about this option becoming in the money, at least relative to the amount of time on the clock and or the volatility. But watch what happens if I make this 60 days to expiration. This delta is going to increase. And there it goes. If I make it 120 days, increases again. 360 days, increases again. We're pushing toward 50. Now I could get exactly the same effect by increasing the volatility. So let's go back to our starting point with a delta of 20. If I increase volatility to 30%, now I've got a 30 delta. Let's increase it to 50%. I've got a 39 delta. Let's increase it to 60%. See, we're pushing toward 50. Now the final point to make is that this is only true under what we might call reasonable conditions. If you start getting into super high volatility, then these deltas are actually going to start exceeding 50. So watch, even though I've got an out of the money option, if I put, let's say, maybe a 200 volatility, see, now the deltas will actually start going above 50. See, now I can actually get them to 64. And in fact, if we get really crazy with it, I can actually push it to where it becomes shares of stock. But once again, those are discussions for another day. The thing that I want you to understand right now is to just always remember that all option deltas move toward a half or toward 0.5 as you increase time or volatility. That's the Trumpification effect. And if you understand this, you can put it in your favor, move it in your corner via strategies. And if you didn't understand it before, at least maybe now you realize why you might have had some unexplained losses. For anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course and Strategy Lab at optionsa2z.com. You can also instant message me right here in Facebook.